I believe that the majority of investors make all the wrong decisions in bear markets. Now just think about it. Your portfolio has crashed 50%. Every day you go up and it's worse than the day before. It's wiped out maybe 5 to 6 years of your gains, and you're thinking, at least I got this little bit left. I'll be okay as long as I just protect that. So you go to cash, you go into some sort of defensive stocks, or you even hedge, and that's just about the time the market capitulates and it goes up to have one of the most fantastic bull runs of the next decade. And you're kicking yourself. So, what's the answer? Well, before we get to that, you really have to answer one question. Do you believe that market crashes are temporary or permanent? Now, if you think that market crashes are permanent, you probably shouldn't be investing. That's like going onto a ship saying, I think there's a good chance that we're going to sink in the ocean and I'm going to die. Invest somewhere else. But if you think that market crashes are temporary, and most people do because historically they have been temporary, the markets haven't flatlined for all eternity, then you just need the mental fortitude to stick with your plan so that you can get the reward after going through all that pain. How do you do that? How do you build the psychological mindset to invest through the bear market? Well, really, dividend investors have an advantage in this regard. Now, I want to be clear, I'm not a dividend investor. I don't really believe that blue chip stocks are your best investments, but people that do invest in these big, giant, stalwart companies that can stand up an economic crash and have good dividends, they have developed the right kind of mindset. So now let's just go through that same scenario. They bought a bunch of stocks, maybe they're getting a 3.5% dividend. The market crashes by 50%. So now, maybe they have $1 million, they're down to $500,000, but they're still making that 3.5% return on their initial investment. They're still getting the $35,000 coming in every single year. So they have an incentive to stick with their investments just at that. But it even gets better because now they look at their stocks and they say, wow, before I was getting a 3.5% dividend yield. Now I can lock in and get a 7% yield. So instead of trying to go to cash and trying to hedge, they're looking for more money to even leverage in or even buy more shares of the company, knowing that they're like, I'd be really happy with a 7% dividend, and I don't even care if the bear market carries on for the next few years. I can patiently wait because I'm collecting this big dividend check. And then eventually the markets do bottom out, they go up. Instead of buying high and selling low, as lots of investors do, they actually bought more at the bottom and they really profit on the way up. So, what do you do if you're not a dividend investor like me? The next question that you have to answer is why did I buy these stocks in the first place? Like, what kind of investor are you? Maybe you're a high growth investor. So, you look at a company, it's got, maybe projected 30% per year growth over the next 10 to 15 years. Fine. You bought in when the price to earnings ratio was 30, which gives you a PEG ratio of 1, which they say is good. It's fairly valued. If future growth is comparable to your PE ratio, then that's not a bad deal. The market crashes. Now your PEG ratio is zero point 0.5. So you need to fixate on that. Like, what was the reason why you bought this stock in the first place? And now you're focusing on the value of it. It has doubled. You're buying more. This isn't true if you're just looking at the price. If you're just looking at the price and the capital loss, you're going to bail. But if you're looking at the actual company and what you're getting, then you'll be more likely to hold on. This could even be with small cap stocks. Maybe you bought a company because the price to sales ratio was around, let's say, 1. And you looked at the company and they're just barely profitable, but you know that once they really focus on improving their profit margins with time, this is going to be a cash cow. So you wait. The market crashes, and it crashes sometimes even harder in small cap stocks than in bigger stocks. The price to sales ratio is now at zero point 0.4. And you think this is absolutely crackers. Like if I buy into this company in a big way now, whenever the market finally does recover, I'll have just made off like a bandit. So what you need to do looking at a bear market, the first thing is Do you think that bear markets are temporary? If so, then go to the next stage. Fix your attention on not the falling price, but the reason why you bought the company and something of value within it. Could be maybe the cash that they have in the company. It can be the price to sales ratio, the PEG ratio, whatever it is, focus on that. And then as the prices drop, you get more and more excited that you're buying more value for less. And at some point, you're going to say, this is ridiculous. Like, this is absolutely nuts. Why are people not looking at this and buying it up? You're going to go out, who knows? You'll take out a home equity loan, you'll buy a lot of shares. And that's typically the time that the shares and the entire market are going to rebound when things are just too low not to buy.